All right, let's get right into it. You know the feeling. You check the news, and the headlines are all over the place. One says the economy's great, the next one is screaming recession. The market shoots up, then it plummets, all before you've even finished your morning coffee. It just feels like total chaos, right? A constant flood of information pulling you in 100 different directions at once.
And that brings up the big question, the one we all ask ourselves: why? Why does it feel so random, so impossible to get a handle on? Well, here's the thing. A lot of that noise, all those sensational headlines and hot takes, they're designed to get a reaction out of you, not actually to inform you. So in this explainer, we're going to cut through that chaos. We're going to separate the distracting stories from the real drivers and give you a clear framework for what's actually moving the markets.
And to do that, we need to go back in time. I mean, way back. Back in the 17th century, José de la Vega wrote the very first book about the stock market, and he said this: "It is an absolutely brilliant insight that's maybe more true today than it was back then. Markets aren't just about numbers on a screen. They're driven by people, by human emotion, psychology, and behavior. And once you get that, you can start to see the game for what it is." And that game often involves what we're going to call milongas. It's an Argentinian word for a tangled up, confusing situation, which is, you have to admit, a perfect way to describe all the misleading stories, the rumors, and the straight-up manipulation that's designed to get a short-term reaction. Our goal here is to learn how to tune out these milongas and focus on what's really going on.
You know, there's no better way to understand this than to look at a perfect real-world case study. So let's dive into a recent rumor that sent the oil market into a frenzy and see exactly how these stories are built to fool people.
So, get this. Here's the story that started making the rounds. The rumor was that the president was about to give a surprise primetime speech to declare war on Venezuela. Now that sounds massive, doesn't it? A huge geopolitical event that would obviously have enormous consequences for the world's energy supply.
But wait a second. Before you react, just stop and think. Does that actually make any sense? Let's just apply a little bit of logic here. On one side, you have the rumor. On the other side, you have reality. A war would make oil prices go through the roof, which would hammer the U.S. economy with inflation and would actually help countries like Russia by stabilizing their finances. When you just lay it out like that, the whole story it falls apart. It's completely illogical. But logic doesn't always win in the short term. Now here is what's so fascinating. That completely illogical rumor was enough to send oil prices shooting up 3% almost instantly. And then, what happened? The speech was given, Venezuela wasn't mentioned, not even once, and the price just collapsed right back down. It's a perfect textbook example of a manufactured move designed to trap people.
And this chart just illustrates brilliantly how targeted these stories can be. While the overall market, the S&P 500, was actually down that day, just look at the sector performance. Who is the number one winner? Energy. That one little rumor was powerful enough to completely distort an entire sector of the market, while pretty much everything else was in the red. This is the noise we're talking about. Okay, so this is the crucial part. If the headlines and all the rumors are just noise, what's the signal? What are the fundamental forces that we should actually be paying attention to? Well, it really boils down to two key drivers that tell a much more reliable story. First up, investor sentiment. This is just a fancy way of saying, what's the overall mood of the market? Are investors feeling greedy, or are they feeling fearful? Now here's the part that might seem a little backward. When everybody gets super optimistic and bullish, that's often a warning sign. It means that everyone who was gonna buy has probably already bought in, and the market is just running out of steam. It becomes what we call a contrarian indicator.
And this isn't just some theory, you can see it right here in the data. This chart shows us the bull-bear spread from a major investor survey, and you can see it plain as day. For 3 weeks in a row, the blue bars, that's the optimists, are just towering over the bears. This kind of extreme bullishness is exactly the sort of thing that suggests the market is getting a bit overheated and is probably due for a cool down.
Okay, the second driver, and you could argue it's the most important one of all, is liquidity. The absolute easiest way to think about liquidity is to picture the tide at the beach. When the tide of money is coming in, it lifts everything, all the boats, whether they're stocks, crypto, or real estate. And when that tide goes out, everything struggles. The short-term stories just don't matter if the tide is rising. The great economist Milton Friedman said it perfectly decades ago. He said governments really only have two ways to pay for things: through taxes that we can all see, and through inflation and monetary degradation that we can all feel. This process of creating more money, it just never stops. And if the value of our money is constantly going down, then over the long term, the value of real hard assets simply has to go up. This is the powerful underlying current that's always there beneath all the daily noise. Okay, so we've got our new lens, right? We're going to ignore the milongas and focus on sentiment and liquidity. So now, let's use that lens to take a look under the hood of the market right now and really try to understand this recent pullback we've been seeing. Is this a real crisis, or is it something else? First, let's look at the broad market using the equal-weighted S&P 500. This gives us a much better picture of how the average stock is doing, not just the handful of mega companies at the top. And what we're seeing here isn't a crash. It's a classic, healthy correction. You see, the index broke through an old resistance level, a ceiling, and now it's just pulling back to test if that old ceiling has become its new floor. This is textbook stuff.
Okay, let's zoom in on the tech sector, which has definitely felt a bit weaker lately. If we look at the QQQ, we can see it's not in some kind of free fall. Instead, it's just in a sideways corrective phase. It's basically just bouncing between a floor and a ceiling that was set way back in November. And right now, it's sitting right near the bottom of that channel, which could be a potential zone of support.
We can even get super granular and look at a huge stock like Apple. And what do we see? Again, a very typical pattern. It's a pullback that's happening inside a nice, neat, downward sloping channel. This is exactly the kind of corrective action that traders watch really closely. A strong move above the top line of this channel would be a big signal that the correction is probably over and the buyers are taking back control. Now, it's important to see the whole picture. It's not all positive. A stock like Oracle, for example, is showing some genuine weakness. It has broken below a really key support level, and right now, the path of least resistance for it seems to be lower. It's likely headed down to that $172 to $178 range to try and find a solid floor. So even when the overall market trend looks healthy, individual stocks can still struggle.
So let's take this framework and apply it to one more fascinating, and let's be honest, often very confusing asset. How does this dynamic of noise versus signal play out in the world of Bitcoin, which is famous for its wild volatility?
Bitcoin has seen some absolutely crazy swings recently, and a lot of that has been amplified by a pretty complex market condition called negative gamma. Now that sounds super intimidating, but in simple terms, it's just a situation where volatility feeds on itself. The more the price moves, the more it is forced to move. But let's break down exactly what happened in 4 simple steps. So let's walk through this chain reaction. Step 1, the price breaks above a key level where a ton of short sellers have their stop losses. Step 2, as those stops get hit, market dealers are forced to buy futures to hedge themselves, which pushes the price up even faster. Step 3, but then the price slams into a massive wall of people trying to sell around $90,000, and it reverses hard. And that brings us to step 4. The reversal forces those same dealers to flip their positions and start selling futures, which just accelerates the move down. It's a mechanical domino effect. So, after all that violent, mechanically driven volatility, what's the real signal here? Well, this looks like a consolidation phase. The market is just trying to build a solid base. And when we connect it back to our main theme, liquidity, which is expected to get better, that underlying tide suggests the path of least resistance for Bitcoin is probably up, not down.
Okay, let's bring this all home. What are the key things to take away from all this? First, you've got to actively distinguish the market's noise, the milongas and the crazy rumors, from the real signal. Second, that signal is really driven by 2 things: investor sentiment and, most importantly, liquidity. And third, when we apply that lens to today's market, the weakness we're seeing looks a lot more like a healthy, orderly correction than the start of some major crisis.
So, I'll leave you with this question to think about. The next time you see a frantic headline or some wild price swing, just take a breath, step back, and ask yourself, are you reacting to the distracting noise that's designed to make you panic, or are you listening for the deeper underlying signal?